All right, folks, we're going to get started here. Super excited about this panel. Got lots of great folks up here. Go ahead and get things rolling. If you don't know, there's a few new faces up here. I think a lot of you probably know John Santee on the end. John's longtime family friend, goes way back down in Memphis. His son and them, Andy and all of them, do a lot of hunting together. Next is Bob Nimmix. Bob's another life. We've become friends a long time, Bob, right? We've been in some interesting investment deals together, so to say the least. Some good, some not so good. But Bob, yeah, for sure. Peter Mallouk is next. Peter's one I talked to you guys about. Told you came from humble beginnings, like a lot of us, paper route, to DJ, and to billionaire world. Part owner of the Royals, and, enough can't be said about what business Peter's built. So, and next is Jeff Presley. Jeffrey Presley got his own Southworth Capital. And we've started to do some investments with them and some blue collar deals. We're just recently, Andy and myself, not to talk out of turn, I know Andy would say the same. I threw about $500,000 at a deal Jeff put together on an upholstery business out of Tupelo, Mississippi, and a roofing company. We're trying to start a big roofing business. It's kind of going across the U.S. a little bit, and I think Andy might have thrown a couple $1 million that direction. But, we're trying to diversify, trying to get into things, and trying to, make everyone a part of our group and family here open to what we're doing on our investments. And we keep it fully disclosed, open about it. You guys have seen it through the years, some really good ones, some not so good ones. But we're trying to get better, and we thought nothing better than to have some of the best people in the industry come up here, talk to us a little bit about ways we can improve, ways we should be looking to maybe design some of these trusts a little bit differently. And you got some good sources up here in a few different slots. And like I said, to start the conference, Bob and I had spoke several times. And you guys have seen the news down where Bob's at, in the Boot Hill and down into Arkansas. It's bad. It's bad for the farming community. It's bad. People are losing. I'm on some bank boards and obviously some business board, but there's some people losing 6, 7 generation farms. And banks had to foreclose, and things are tough. And like Bob said, if we could just help the American farmer become a better investor on those good years, I think it would really go a long, long way, right, Bob? And we're going to talk at the end about forming our own group. Maybe we're going to talk about, Bob will talk a little bit about, maybe forming our own group of people in this room, put together our own group of investors if you guys are interested in joining us, Andy, myself, Soren, Bob, Tom. I know there's some other guys in the room, but maybe making it a lot bigger if the group wants to partake. There would be no fees or anything like that. It'd be ran like a co-op. But Bob and I think we can get better deals, Maybe not pay 2 and 20 or not pay 1. We can probably get better offerings of some sort, or maybe even influence the market a little bit more with the weight we'd be able to push around. So just keep that in mind as we talk. I'm going to let Bob kick things off, just a little recap of last year, and then a little presentation forward, and then I'll move to Peter, and then go to Jeff and John to talk about some trust and some things like that. So thank you, guys. Bob, go ahead and take it.
Thank you, Kevin. So we kind of have I like to think, a sacred mission here, and our mission really is to, as simply stated, is to preserve a farm legacy for our heirs who want it. That's really what this panel boils down to. Many of us in this room remember, hard work days out in the hot summer sun with our father and mother and grandfather, grandmother, and great-grandfather, great-grandmother, and we want to be in a position to pass that along to our future generations, if there are heirs who want it. And so a lot of our discussion today will be, how do we build that multi-generational farm or investment business? And really, when we think about farms in the future, we really need to be thinking about business. So that's kind of the purpose of this. There's a lot of headwinds, though. I mean, we only have to look past 100 years, and there's only one farm for every 4 there were 100 years ago. So we're just continuing a path towards consolidation. When you think about the next 100 years, will there be another 3 out of 4 farms that pass and those consolidated into ever bigger farms, or even more consolidation? That's a big question for people that are trying to preserve a farm legacy for their heirs. The average size farm has tripled, which is no surprise to anybody, but down in my area of the country, I would say the average size farm now is about 5,000 acres. And you know, cropland is consolidated. It's had to consolidate. You look at cotton prices, and they're horrible, and you really have to be big to afford one cotton picker. It takes about 2,000 acres of cotton. So, at a minimum, you've got to raise 2,000 acres of cotton to be a viable farmer. And most farmers I know have many cotton pickers, so they're raising 10 to 40,000 acres. So as a result, our percentage of the U.S. population has fallen from greater than 5% to currently less than 1%. My son tells me that we're still a preferred class, that farmers are still viewed very favorably. The public's picture is of a farm family working hard under the Iowa sun, and it brings back nostalgia. So, but as our farms consolidate into tens of thousands of acres, then how long will we have that preferred class as or will we be viewed as just another industry with some very wealthy farmers? So the question to this panel and to the audience as a whole is, how many farms ultimately will the U.S. have? To answer that question, I like to look at the industry, the supply chain, and I currently track a number of publicly traded farm suppliers around the world. 32 are active in the United States. These are publicly traded firms. Many of you know them quite well. And then on the farm market side, there's another 20 or so publicly traded ag product marketers that I track here in the United States, and you can double that for marketers outside of the United States. But in the middle is 1.8 million farmers, and so we're a very undisciplined industry, and the asset that we manage is $4.4 trillion in value. And the USDA will tell you that only 600 billion of that is in debt, so about 13% levered. That's a very healthy asset. But with 1.8 million farmers, we're very unruly. How often, when commodity prices fall 20%, do we plant 20% less acreage? Imagine if instead of 1.8 million farms, we had just one U.S. farmer, and his revenues fell 40% since 2022. You can bet he would go to John Deere and say, I need a 40% reduction in my equipment prices. And he would go to ADM and Bunge and say, guess what? You're going to have to do a much better job of marketing my crop. And they would listen, but with 1.8 million farmers, Deere has one word for you when you say you need a 40% reduction in their price. They say next. They'll just go to the next farmer and see if they're willing to pay. So it's an undisciplined industry, and we'll talk more about that. It really, the economics dictate that we grow or exit. And so the growth challenges, though, are we have a whole bunch of new competitors when it comes to investing in farmland and trying to expand our operations and grow buy the adjacent acreage to our farms. There's a bunch of competitors who also want to buy that adjacent acreage. What the institutions view farmland as an asset class that they can use to hedge inflation. It's a diversification move on their part, along with gold or Bitcoin or warehouse space. And so they are buying a lot of farmland. It's a small, very small fraction of the trillions of dollars in value of the total asset base, but it is one that's expanding rapidly. Since in the past 15 years, the value of institutional farmland has gained a tenfold. And the number of properties that are owned by institutions, the top 7 largest institutions have increased their ownership of properties more than double. And then added to institutions, of course, there are a lot of high wealth investors, including retired farmers who have also been competing with operators to acquire land. In our area of the country, as a result, operators own less than 70%, less than 30% of the land they farm. In the Mississippi and Arkansas Delta, it's not uncommon for a farmer to rent all of the land that he farms. And that's true of one of the farmers that farms for my family. And then lastly, of course, another headwind is there's always the industrialization of farmland, and it's estimated another 18 million acres will be taken out of production between now and 2040, which represents about 2% of the farmland base. So as you can imagine, cropland prices with this buying pressure and also with the retirement pressure from industrialization of farmland is seeing farmland prices escalate quite rapidly. According to the USDA, since 2000, farmland prices have gone up fourfold, about 400%. When we look at commodity prices, it makes sense. When you look at the first decade of this century, corn prices and soy prices were rallying faster than land prices, so land was a lagging variable to commodities. When commodity prices sold off around 2010, 2011, land prices flattened. When commodity prices took off again in the 2020 and around the Ukraine war and so forth, land prices took off again. But look what's happened since 2022. We've seen commodity prices fall substantially, but yet land prices are going even higher. In my county in Arkansas, we saw a new record set for rice land in October, sold for about $7,400 an acre. That's phenomenal because the record 5 years ago was $5,000 an acre for rice land. So how can you make rice economics work when the rice price per pound has gone from 17 cents a pound to now less than 10 cents a pound, and yet we're setting all new records for rice land? It just is contrary to logic. With that's the rice prices, and you can see rice prices even further as a percentage relative to farmland. And then pity the poor cotton farmers in our area who have been living with this for some time. Cotton farmers tell me in Arkansas they lost $200 an acre on their cotton crop this year, which is a tough pill to swallow when you consider the capital investments and the labor that goes on in trying to raise cotton. So 4 broad options available to operators that I can see. The first option is grow smarter, not bigger. In this time of phenomenal land prices where they're completely out of sync with commodity prices, the idea is make a business, not a farm. And so a number of firms in Arkansas, my humble state, are doing so. And one is Matthews Ridgeview Farms in Cross County. He discovered that cotton ground grows pretty good sweet potatoes. He's tripled the size of his operations over the past couple of decades. They grow a sweet potato that's specifically targeted towards sweet potato fries. And so he's got brand names, he's got a marketing team, he's got a sales team, and he's got an R&D team. It's very much like a business, not a farm. Another in Lonoke County, not far from to the west of us, was in the catfish business. They couldn't make money growing catfish, so they switched to minnows, and now they're the world's largest producer of minnows. They grow more goldfish than anybody. And you say, well, you know, a minnow, it sells for 10 cents. I mean, big deal. Well, they grow 1 billion of them. So on about 500 acres, they're doing $100 million worth of revenue in minnows. So, you know, you can see where the revenue improvements have been in thinking outside the box. Just down the road from them is Keogh Fish Farms, and Keogh will sell you sterile grass carp to clean up the pond that you have in your gated community. And once you've cleaned up the moss in the pond, they'll sell you striped bass fingerlings to go in there, and striped bass grow up to 80 pounds. They're the world's largest supplier of stripers, we call them, striper fingerlings. And so these firms are rapidly establishing brand recognition and pricing power. And so that's what a lot of this conference is about, is thinking about ways to establish pricing power, brands, and think about business, and a lot of companies here that are doing so. There's more in Arkansas I won't go into. Here's a brand that you might recognize. This firm started as a small trucking company, bringing chickens that couldn't lay eggs to Kansas City back about 90 years ago, and that worked well. And so they started expanding, and it worked so well, they brought in chickens from New England called Rhode Island Reds, and started encouraging their growers to grow Rhode Island Reds. And then they started producing high protein feed. And today it's the powerhouse that it is. And then the last creative example I have is this company, which we all know that Kevin started with a farm. His grandparents were farmers. And over time, he's innovated and come up with ideas. It led to commodity trading, to a daily newsletter, to FarmCon conference, to Ag Swag. Look at all the ways that he's been able to innovate. And this is, so the build a business, not a farm approach. The next is optimize or exit. And for those of us, optimize and exit. And for those of us that don't have heirs that are particularly interested in farming, this may be the approach we take. This is an example of a farm. My colleague John Santee will like this. This farmer in 2010 was farming a farm between the St. Francis River and Crowley's Ridge, which put him in the floodplain of the St. Francis River. You'll see the river levees on the east side of the river, and about 1,400 acres. Well, the river traditionally got out of the banks and flooded the crop, one out of every 3 years. But we had a string of bad years in about this time. And so the farmer threw his hands in there and tried to sell out. He found a guy from Atlanta who bought it. And he hired a farmer, and they didn't have much more success. So in 2018, he converted the entire farm to Wetlands Reserve Program and turned his $1.7 million investment into $2.8 million. So he did fairly well on that conversion, but he also was smart enough to start making it into a duck hunting club. And in 2023, he sold to a duck hunting club developer like me who for $3.3 million. So over the course, his annualized rate of return for that 13 years was 13% unlevered. If he had levered that investment, say 50%, his return on assets or equity employed would be well over 20%, which is excellent rate of return. You might think, well, he got lucky selling that farm for $3.3 million. That's crazy that you'd spend that on a duck hunting club. But the guy who bought it is taking that timberland to the northwest and converting that into deer hunting, really improving the turkey population. He's bringing in quail, and he hopes to sell it to this guy. And so, or this guy's friend who just paid over $10,000 an acre for Georgia pine land. Georgia pine land that was probably selling for less than $500 an acre 10 years ago. So it's amazing what this recreation market is doing. And if the optimize and exit strategy is a strategy that's one that's attractive to you, there's a lot of buyers out there who are willing to pay up for recreation land or for solar arrays or for whatever development you want to do. The third approach that I see to operators that are trying to grow in this land-constrained market is align with non-operating landowners. And these 5 guys all have something in common besides being billionaires. They're all owners of farmland in St. Francis County, Arkansas. And so they're my neighbors. And every one of them, if you approached Bill Gates and you said, Bill, do you own land in St. Francis County, Arkansas? He wouldn't have a clue. And he would point to his family office manager, and the family office manager would bring a clerk in, and they would look up on an Excel spreadsheet and find, yeah, they own land in St. Francis County, Arkansas. What do you think the farmer who farms that ground for them is most concerned about? It's not about paying rent. Bill doesn't care about rent so much. He cares about capital appreciation. When he flies across that farm, he wants to believe that that farm is getting more and more valuable every year. So he wants to see very neat turn rows. He wants to see weedless fields. He wants to see accurate contour irrigation systems. He wants to see the capital appreciation. So as the farmer, he doesn't care whether you're paying him $100 or $200 or $250 an acre rent, whether it's crop share or cash share. So the farmers that farm for these guys are doing very well in St. Francis County. It's a great approach. It's sort of the, if you can't beat them, join them approach. And then lastly is kind of what we're going to talk about here, and that's the hold and wait. And the hold and wait strategy is based on this. This is a chart that shows land prices going back 115 years. And so in 115 years, land prices have gone up about 130 times. So there's a book written called 100 Baggers that talks about investing in things that go up 100x. Well, this is 130x investment if your family was early enough to invest in that. But there were 3 periods in there when farmland prices didn't just go up. And for those in my age, we remember the 1980s and 1990s when it was very tough and land prices were actually going down, not up. So for us, our approach is let's invest in something that goes up faster than land prices and wait. And wait until that next downturn in land prices and see if that's the opportunity to establish the scale we need in order to pass this farming operation on to the next generation. And so the competitors that we have made their money in things like the S&P 500 or companies that represent the S&P 500 like Microsoft. And so if we can invest our money and earn returns that are much faster than farmland, then we're prepared and we're not losing ground, we're not losing our buying power, as even though farmland continues to escalate by as much as 5-10% a year, we're earning something much more than that. And we'll talk more about that in the latter part of the panel, but that's kind of how I see things teed off, Kevin.
Appreciate it, Bob. For those of you, Bob trying to trick you a little bit with that country draw. Got that southern country draw there. And I always tell you guys, I open you up to my network, and Bob's probably one of the best at looking at investments, analyzing investments. Bob's wife, I believe, sits on still a couple of boards, Fortune 500 companies. Bob's son's one of the managing partners at BlackRock. So I'm letting you know.
Blackstone.
Blackstone, excuse me. Yeah. Blackstone, excuse me. I always get those two mixed up a little bit. Both really great though. And like I said, just unbelievable intel coming from Bob and his group. And let's turn it over to Peter because I think it was a great lead-in to what Bob was showing you with the S&P versus farmland prices. And a lot of times we don't recognize that or realize it. But Peter has built an incredible business. I think really talking to people about longer term growth, just staying invested, kind of what I was trying to show you guys on the market drawdowns. You're going to have a 10% drawdown every now and then. You're going to have, 20% shakeouts. You're going to have a longer term vision, a longer term perspective. I love this. This is on Twitter, on X. Peter puts out, we follow Peter, and you guys will see him in the report a lot. And I love he's a very positive, and he puts a lot of optimistic things out there, and I like that. I'm a glass half full guy. So, Peter, I'm going to turn it over to you and kind of let him tell you your theory and your thoughts on, maybe ways to invest or things that people haven't really looked at or thought of in longer term plays. So go ahead.
I've been to a lot of conferences. This is the coolest one ever. This desk and the whole setup and is awesome. So I love it. So I'm glad to be here. And I, on the way in, got to meet a couple creative planning clients. So I imagine there's more in the room. So this is extra cool because of that, having it in our backyard. Given that you just said, just share a little bit about your ideas. Whenever I have a very short period of time, I try to focus on one idea that I think permeates everything when it comes to investing, because you're farmers, and then you also have stocks, and you have bonds, and you have private investments and all of that. And I think a really easy way to understand the investing world is to realize that there's really only two investments. You get a pie chart when you go to your investment advisor, and it's got 27 different things: small cap this, international that, emerging markets, land, whatever. But there's really only two investments. You're an owner or you're a lender. That's it. You're an owner or you're a lender. So let's talk about some basic investments everybody talks about. You loan money to the federal government, safest investment in the world. We call that the Treasury, because they'll tax people or print more money to pay you back. But one way or another, they're going to pay you back. So that's why it's also the lowest return that exists, because it's the safest. You loan money to Iowa or Des Moines or Topeka, we call that a municipal bond. And they have to pay you a little bit more on an after-tax basis, because there's a higher chance Topeka will go under than the U.S. government. They can't just print more money. Every now and then a county or a city or state goes under. It's also a loan. You loan money to McDonald's, Microsoft, Google, corporate bond. It's a loan. They got to pay you a little bit more than the municipal, because it's more likely that a business can go under, like an Enron. There's millions of examples of this, that are doing the right thing every day, but time just passes them by. Like in Kansas City, we've got AMC theaters. Maybe one day, if you loan the money, it won't work out. We call those high-yield bonds, or some people call them junk bonds, if you start to give them to companies that have higher risk. So the Treasury is the lowest yield, then the municipal is more, and then the corporate is more, and then the scarier corporate is even more. We call that high yield, but they're all just loans. And we hear a lot about private credit. Private credit just means the company's not public, but they want to borrow money. Like at my company, Creative Planning, if I wanted to borrow money, I can't go to the bank and borrow $500 million. They don't do that anymore after the 08-09 crisis. I can't issue a bond. I'm not publicly traded. So I go to what's called the private credit market and I borrow money. All of these are just loans. But on the owner side, U.S. stocks, international stocks, emerging market stocks, farmland, any land, rental properties, private equity, where you invest in a fund that goes and buys private businesses, with all of those, you're an owner. And if you look at what drives returns, what this graph has in common is there's an interesting time, and I thought the graph you showed about the S&P 500 to farmland is interesting, because the reason all the ownership things are generally correlated is because they are inflation related. So if we're living in a world where the federal government is going to spend $1 trillion more than it collects every quarter, okay, this really was a problem for a long time, and under the Biden administration it got much, much worse, and before you Republicans get too excited, then under Trump somehow it got even worse. I don't understand it. Between these two presidents, we've accelerated the debt spending by $1 trillion every couple months. Now, the problem with that is the way inflation works is a lot of people fight about, well, where does this money go, right? So some people say, well, it's going to social programs where the money is wasted. And some people go, well, we gave forgivable loans to business owners and corporate bailouts and tax breaks for the wealthy where the money's wasted. And for the investors' purposes, it pretty much doesn't matter where the money goes. So let's imagine the federal government every quarter just took printed $1 trillion and randomly put it on street corners across the United States. People just go pick up the money and then they go spend it. And because there's more money chasing the same amount of things, you have inflation. And who wins with inflation? Owners. Inflation is very bad for the country because most people are not owners. 90% of people don't own a farm, they don't own a rental property, they don't have a substantial amount in their 401k, they don't own a lot of stocks or any stocks, they don't have equity in their home, or they don't even have a home. So if you're going to work and you're making $60,000 a year, which is I think a little higher than the average American makes, median American makes, and everything costs 30% more, you've got a problem. Things are very, very rough. But if you're an owner, if you have a lot of money in your 401k, if you have a lot of equity in your home, if you have a lot of stocks, if you have farmland, you feel much wealthier today than you did right before COVID. That's because you're owners, and in an inflationary environment, owners win. That's just how it works. And the irony of it is we are winning while things are generally getting worse. I mean, imagine that you own $1 million house in a cul-de-sac, and you have $1 million of debt. You come in to see your advisor, and a creative planning advisor would say, hey, this is a problem. You have $1 million house and $1 million of debt. This isn't fantastic. I think you should stop spending so much money. Well, you don't want to hear that. You're going to fire the advisor, right? Instead, let's say the advisor has a magic wand, and they say, you know what, you've got $1 million house with $1 million debt. Don't worry about it. Come see me next year. And then they wave the magic wand, and they lower interest rates to 2%, and they give all your neighbors $400,000. All of a sudden, your home is worth more because people can afford to pay more for it because interest rates are lower. When people buy a home, they don't ask how much is the home. They ask how much can I buy for my monthly payment. And everyone has more money from the stimulus checks or the forgivable loans. And then your home's now worth $1.4 million, the debt's still $1 million, you feel wealthy, you are wealthier, inflation made you feel richer, but Alan Greenspan is famous for having been quoted as saying, he was the former chair of the Federal Reserve, inflation is the hidden tax. You know, people will, when you take the purchasing power of $1 away from somebody with inflation, they're smiling. And the reason is that home goes up in value, you feel better. But what really happened is your property taxes went up 40%, and everything you want to do, you want to go to Disney World, you want to go fly on Delta, you want to go to a conference, everything costs 40% more. So you feel wealthier, but in reality it didn't change much. Now if you're an owner with income producing assets, you can move ahead of inflation. So those of you that own stocks that have dividends plus growth, you own farmland, you have income plus capital appreciation, you're ahead of inflation, it's fantastic. But for most people, that's not the case. So if there's only one big lesson in all of investing, and I think that impacts your day-to-day life, it's be an owner. Unless you believe that somehow there's gonna not be deficit spending and money printing and all those things, I don't see that anytime soon. You have to be an owner to stay ahead of everything. And the people that have been owners, and you all have been owners, most owners are accidental owners. They just happen to own businesses, they happen to own farms, they happen to put money in their 401k. Some people are intentional owners, like how do I take every dollar and direct it towards ownership? But over the long run, owners will win. Not every year. 1 in 4 years, it's gonna be very bad to be an owner. You have a negative outcome, whether in US stocks or international stocks or real estate, although in real estate we can all lie to ourselves, right? When you update the net worth, the real estate never goes backwards, but the 401ks and everything else do. My business never goes backwards either. All those things that don't get priced daily, you can leave them at their high water mark. But in reality, owners go backwards about 1 in 4 years, but over a decade, they're positive 97% of the time, and they stay ahead of inflation. So the key to building wealth and a necessity to building generational wealth, which is what I know everyone in the room is focused on, be an owner.
Peter, I had a question for you. And I know everybody in the room has a question too. What do you think happens with all this massive government debt? You know, how does that impact us as longer-term investors? How does it unravel, unfold the whole dang global debt crisis?
Anytime a problem seems very complicated, you can almost just turn it into a household. Like if you want to have a conversation about immigration or crime or money or whatever, just take the whole economy or and put it into your house. So let's take deficit spending. You know, let's say that I've got a house and I'm living a $500,000 a year lifestyle, but I make $200,000 a year. So I have a chef, I have a groundskeeping crew that's there, you know, all year. When they get done, they go start again. I've got a nanny. All of those are in my house all the time. My nanny, my chef, my landscaper, and I'm going backwards $300,000 a year on my credit card every year. There is going to come a day where the credit card company is going to go, you know what, Peter, you pay your bills, but we're starting to wonder, like, should we loan you money anymore, or maybe we should go loan money to somebody else? So at that point, I have to go back to my normal lifestyle. What happens when I do that? I have to fire the nanny, I've got to fire the groundskeeper, I've got to fire the chef, and you have a depression, right? All those people are out of work, they're not going to Disney World anymore, so you have a tremendous contraction. The problem with our system, which is largely wonderful, but this is a big problem, is the people that have the credit card, they get the credit for the party, right? Have the nanny, have the chef, have the landscape, and then someone else gets elected later. Someone's eventually going to get stuck with this hot potato, with this credit card. That moment will happen when the world decides they would rather loan money to somebody besides the United States. So right now, if you are in China or Europe or Africa or South America, and you have a bunch of money in your sovereign wealth fund, a lot of countries, unlike the US, have a surplus instead of a deficit, they have to allocate their capital. And the part that they say needs to be the safest, they loan it to the United States. Now, with all our problems, safer to loan the United States money than to loan the European Union money, right? Will the European Union even exist in 20 years? I mean, maybe 50-50, right? It's safer than loaning it to China, which has a history of every few decades deciding to just confiscate everything. Who are we going to loan it to in South America? Who are we going to loan it to in Africa or the Middle East? So it's the dirtiest, it's the cleanest shirt in the dirty laundry, is how I would describe the US dollar, right? So today, we are that place. But, you know, newsflash, everyone hates the United States, right? And so they don't want to loan money to the United States. And every now and then, some of these countries get together and decide they're going to reserve in other currencies, like Venezuela decided before what just happened, or Brazil is leaning towards, or China is now doing, or Russia's now doing, and so on. There will eventually be a currency that people trust, whether it's going to be China or somebody else. And when that day comes, what will happen is the world won't say we won't lend anymore. The US right now might say, hey, we want to borrow money, we'll pay 4.5%, and everyone says okay. The US will have to say, well, we'll pay 6% or we'll pay 7% to entice the money to come over, and that causes, you know, massive inflation, right? A big, big, big crisis. And so it is a debt that has to be paid. There's going to have to be some kind of resettlement. But if you think about the only way the government can do it without having the default scenario is they have to inflate their way out of it. So let's go back to the owner of the house, $1 million of debt, $1 million house. How did I solve the problem? I waved my magic wand and I gave everybody a bunch of money and it inflated things. Let's say the United States still had, you know, 40 trillion of debt and just, you know, over the next 5 years had a balanced budget. Let's just imagine that. Normal inflation would make 40 trillion not seem as bad 10 years from now as it does today, right? So you can, like even $1 million house with $1 million of debt, if we can control the debt at $1 million 10 years from now, the home will be worth 1.2, 1.3 with just normal inflation. So the government has an incentive to create inflation, to try to contain the debt relative to the inflation. Because the things that back the dollar are all the land we have, all the oil we have, all the natural resources we have. If those things are inflating at a higher rate than you can get out of it, the problem is that creates social division, so it brings you another issue. So deficits are always bad. growing deficits are always bad for a society because you will have to pay for it one of those two ways.
And I think, and you folks can talk here in the room and tell me if you agree. My grandfather, and I think his grandfather, they came over, like I said, he came over from Germany, but my grandfather was scared to put his money to work in the market a lot. And I think a lot of the people who established farms and headed west and were pioneers, and your grandfather and your dad probably said the same to you. Be careful hedging, be careful putting money to work in the markets. You just don't know what's going to, how that's going to play out. And we've missed a lot of the moves. It's shotguns, canned goods, and a bin full of corn. I mean, that was kind of the motto, right? And you really didn't want to put your money too much at risk. So I think people are scared that, they see what's happening with politics. They see the 37, 38 trillion in debt and going higher, and everybody's nervous. That's why we got the guys downstairs selling gold and silver and gold bars. And I don't know. That's a tough one, though, in our industry, isn't it, Bob? You would agree, John, you guys? I mean, it's tough so that's kind of what I'm just trying to talk about and overcome maybe is a little bit of our fear in that and putting money to work. A lot of farmers don't have 401k. They don't have, retirement accounts set up. They don't have Roth. They don't have 501, they don't have the college funds set up. They don't have the Dynasty Trust. They just don't have those things. So, I think we just got to do a better job of trying to educate and help people learn more. And there's ways to play it and kind of be safe. Would you agree, Peter? I mean, I think there is. So,
I would just, I would say that there are two risks. The one risk is that you don't have the money you need over the short run. That money should be in cash. That should be in bonds. That should be accessible. Do I think that will do worse than stocks and land and real estate over the long run? Yes, of course I do, for all the reasons I talked about. But we still know that there are many, many, many periods of time where ownership is negative, 3, 5, 10 years, as we saw in the chart earlier. So you have to have money accessible for that interim period. It's that 5-year plus, 7-year plus, 10-year plus money where you should be fighting the other risk, which is that the government every year is taking away some of your purchasing power. I mean, that's just the reality of what it is. If you took $1 million and you put it under your bed 10 years ago and you pulled it out today, that $1 million would buy $430,000 worth of stuff. If you were a bond owner, you would have actually lost purchasing power after inflation. But if you were an owner of farmland or stock or real estate, you were far, far ahead of it. So there's two strategies for two risks. You're a lender for the short-term risk that markets will be down for a million reasons. COVID, 9/11, the tech bubble, 08, 09, whatever. It's always something we're not thinking about. You've got to protect against that risk by being the lender over the short run, but the long run money, you protect against the inflation risk.
For you, if you don't know, Peter owns Creative Planning. I believe, did you guys just buy Goldman Sachs' private wealth division? Yeah, they bought Goldman's private wealth division. And so he owns Creative Planning. If you guys are looking for things or you need some, we're going to take Q&A here at the end, but I'm just saying there's people here that can help you put a lot of these things together. I know John as well. Jeff, go ahead and kind of tell us what you've got going on in your world and what you're seeing in the investment landscape.
Yeah, so my business is a little bit different. Southworth is we probably rhyme with private equity more than we are. It is a family office that invests in operating businesses, that we form a foundation of a holding company, and then we will use both organic and acquisition growth to grow our platform. And basically, and I think your recap was outstanding, and sometimes when they're talking about the difference between debt and ownership, the mix is about your time horizon, right? And so that's where that mix comes in when he's talking about mitigating your short-term cash risk, right? Well, on our structure side, we have some ways to sort of manage those things. And what I see, which is something I think a lot of the people in this room are facing, is we've had a generation of ownership that has not transitioned that ownership either to the next generation, nor have they created a liquidity event that will allow them to diversify their portfolio of holdings. And it has happened in a period of time that it has exceeded the typical holding periods. I think one of the earlier guests talk about the transition of wealth between the generations that happened for 3 or 4 generations in a row. And then we got to this generation, it kind of capped off. Some of it is the quality of living, some of it is the longevity of life, some of it is the good job that people have done creating liquidity and assets that has allowed you to remain an owner longer than you might have before. But we are now to the opportunity of the greatest generational shift of wealth. It's certainly in the history of our country and maybe in the world, where we're going to see the ownership group transition out of this business. And they've got one or of 3 ways to do it. They can simply close the business. They can say, okay, I owned this business for a long time. It was my passion and I viewed it as a stream of cash flows. And so now I'm not in business, so the business doesn't exist. The second is that they sell the business, and you've got this large block of people that are coming onto the sale of the market, and so what will that do to values? And then the last is to achieve a manager-managed business. And what's interesting is the farm industry has been ahead of this for a long time because operators have leased property for a long time and operated other people's facilities, right? But when you think about painters or HVACs or any of the industrial trades, the opportunity to move to a manager-managed business exists today. And we had this guest talk about AI. The tools associated with reporting in AI should start to make manager-managed business more of a reality. Why do old people like me not want to turn the keys over to the next generation or to a manager-managed business? Because you can't see your money every day and you're used to going to work every day and seeing how it works out, right? With the use of tools and AI and the evolution of family offices, things like that, you can take your existing set of assets, you can take your operating companies, you can hire qualified operators to run that business, and you still have the tracking mechanisms in place where you can get comfortable. You can literally look at where your cash is on your phone on the day that you just say, hey, I want to know what's going on. The space in particular that I play in is in the acquisition of these businesses and growing them. We were talking about cash earlier. There is more cash chasing investments than there are available high-quality investments. That's part of what causes the inflation in the value of the investment, right? More money chasing the investments. Wealthier generations pushing dollars out to earn. And so what we do is we will buy companies. We will aggregate those companies into a dollar volume that becomes an investable asset. So you buy good companies, but you got to turn them into investable assets. That includes things like reporting and governance and measurable metrics and all of the kinds of things that institutional investors have to put their money in. But the difference is the institutional investors will look for a rate of return somewhere between 14 and 22%. And to the extent that you can buy private assets, combine them, and go from the owner class and sell to the investor class, the spreads on them are substantially larger and the returns are greater. Now, much like you, in terms of operating farms, the risk is in the operation of the business. Every day, I look at one of the companies and I say to myself, this was a really good idea. And then a knucklehead drives a forklift through a wall. And I think this is less of a good idea today. We've got roughly 80 businesses and 3,500 employees in 11 different industries. And so the new ways that they find to challenge my patience is pretty impressive. But you're spot on. It's the value is grown in the ownership. And sometimes you won't look at private equity because you'll say, well, I'm farming, this is different. It isn't. Everyone in this room already owns their own family office. Your asset base is your core farm business that drives cash flow, that creates opportunity for diversity investments. That's all that's happening. It isn't more complicated than that. We go to somebody in an industry like HVAC and electrical, you combine those businesses, you start at zero, you buy the first one over the course of 3 years, you've accumulated $30 million worth of EBITDA. That is the size where the larger private equity firms can step down and purchase it at the multiple returns that they've got. The entry point in that particular case was 4 times. The exit comes out at 8 times. The spread is really driven by the number of dollars chasing too few assets. They've got an investor return. We establish an ownership return. And then that is basically how we get to what we do.
Yeah, one of the last deals Jeff did, and I don't want to talk out of turn, just to give you guys an idea, and why I like it is because I come from a blue-collar background, right? My dad was in the HVAC business. My wife's dad was an insulator. These are the businesses we know. And I think as AI comes on, there's going to be huge opportunity in some of these blue-collar businesses. The last one was cranes. Jeff was, there were a lot of small crane companies.
A lot of small crane, just like
Tell them, Jeff.
farms. Your original slide showed there 1.8 million farmers, right? The average crane company was worth less than the cost of the cranes, right? They're spread out all over the place. And most of them are owned by people who are the crane operators themselves. So you go in, we'll come in, we'll give them some cash, they'll have some preferred, which has a current coupon, which helps replace some of the ownership income, and then they have an economic interest in the inside as we go to grow the business. I'm a believer in everybody eating dinner at the table at the same time, and so I like to get the incentives aligned. And so we're able to grow that business. I think our average acquisition on the crane business has been in about the 3.8 range. And we've got JP Morgan is helping us on this one, and we think we'll exit somewhere in the neighborhood of 8 over the course of 5 years.
Yeah, and the next one, like I said, we threw at I think it's one of the largest American upholstery companies in Tupelo, Mississippi. But the owners are kind of staying intact. We're buying out part of it. Jeff was all excited when Trump put the new rule in place that there'd be no upholstery brought in from outside the U.S., basically. So we thought it was the right place at the right time. And the same thing, and this is what, it's kind of what GM did with the automotive early on. They siloed, they used their in-house accounting, their in-house, all the things that Jeff has brought to some of these mom and pop businesses. He brings that in. He's got what the private equity players want to see on the exits, puts the right books, right numbers in place, consolidates, and brings together some of these mom and pops in various blue-collar spaces, and then we look for an exit. And like Jeff said, typically 3 to 5 years is where it is. So it's another play. It's just another play I was going to, to talk to everyone about, to show them there's alternatives out there. I think, as Peter would tell you, if you get with a good financial planner, obviously that's at the upper end of the pyramid.
That's what I would say too.
Go ahead,
Like
Jeff.
this is the bulk of the money is in the items that create liquidity. A little like the farm, when you buy, we own the company that painted the Disney World castle. It was a gigantic paint by numbers, believe it or not. You just go in there. But you can't just sell that because you need some money today. You're in that until that investment is over. Right? Like the farm, you can't just decide, I'm getting out of the farming business like this. They're operating businesses. That's why there's got to be a mix in a long-term portfolio that has access to liquidity, returns, as well as investments. The great thing about really the group you've put together and the group that was before is the free market, the market itself, it gets bounced around in the news some these days. But that is what creates freedom, right? Money doesn't make your life better. It gives you the choices to have better options, right? And getting back to the principles of investing, time horizons, transitions, and generational wealth. I think it was the speaker on AI. Be very clear and determined on what your objective is, right? If it is to create generational wealth, take the steps in your life and the operations of your businesses that allows you to create that wealth in a manner that transitions those values as you want them to, right? That's the benefit of great planners, is if you are clear about what your objective is, we are in an environment where the assets are out there to grow those values and make that transition happen the way you see fit.
John, I don't know if how many of you, so Michelle and I, we tried to set up trusts that would live past all of our kids and their kids and their kids and their kids. I mean, got lucky on a few things, hit a few good licks, and put them into some dynasty trusts that will continue to live on and live on. And there's some ways to formulate things and other things. John, you want to touch base a little bit on some of those and different things that people could be looking towards to generational wealth building?
Thank you, Kevin. Appreciate being here. I wanted to connect a few dots, if you don't mind, because believe it or not, there's connectivity that we all have. So if somebody could pull up those slides real quick. By the way, while we're waiting on that, how many Ole Miss football fans do we have here? Come on. Can we get a quick hottie toddy? Come on. So I'm waiting on these slides real quick. But I met Kevin about 10 years ago. Everyone's talking about Andy Daniels. I'm sure most of you know Andy. He became my neighbor about 20 years ago in Memphis, and his daughter was being treated, and everyone said, you got to meet Andy Daniels. Well, sure enough, one night Andy was trading and drinking whiskey, and we've been great friends ever since. MFO USA is my multifamily office. Peter, I was in the investment business with Payne Weber and UBS, but the tagline here says, investing in America's heroes. I truly believe our American veterans allow our economic system to run. So we work with Woody Williams Foundation and Gold Star Families, giving back. And then our American entrepreneurs, they're heroes. I mean, this country's like no other. And of all the entrepreneurs that are out there, farmers were the original and farmers are the toughest. So that's one of the reasons why I'm involved in this industry. If you'll change the slide real quick. This is my career, and the reason why it's important is because it kind of touches a lot of people in here, but I spent the first 15 years in the investment business, Peter, and then eventually sold that business, and that's about the time that I met Jeff Presley, and the next slide will be much more impressive when you see it. This is Jeff's slide. This is what he's done the last 20 years. These are all the companies that he's built. But in addition to working with Jeff, Gary Harshberger's in the room. I'm going to mention something he's doing in a moment. I met Gary through Andy. Carter Williams, many of you have heard through the years. Carter knocked on my door about 10 years ago, wanted me to help him with iSelect. And I was always enamored with venture capital and the ag tech sector. I introduced Carter to Andy. Andy introduced Carter to Kevin Van Trump. I introduced Bob. So there's a lot of connectivity. That's one of the things I do is connect folks. I'm here today with two of my junior partners, William Burns, my son Xander. So I've actually become a financial entrepreneur accidentally. I did not know Jeff Presley was going to go from a warehouse on Summer Avenue to where he is today. But I got a phone call from a friend of mine who's a Harvard West Point guy. He had left AutoZone, said, you got to meet Jeff Presley. He's the smartest guy I've ever met. I meet Jeff, and I said, what do you need? I need a little money, so I give him a little money. I didn't have sense enough to just partner directly with him. But somehow I've been involved in most of these companies with Jeff. And so the connectivity is important because it builds trust. Not everything we've done has worked. But there's a guy named Byron Trott. He was Warren Buffett's investment banker. And if you Google him, recently he was interviewed, and he talks about the importance of the investors, the co-investors. Do these people lean in when times are bad, or do they run out the door? And so what we're doing today, what I've done for Jeff, is I cultivate investors that essentially what I call J-Dogs. They're Joint Development Operator Group. And the reason why I say that is they've operated things. They've been bankrupt before, some of them. Some of them have been through bad marriages, whatever, but they kept leaning in. They're optimistic. And so when Byron talks about this, he talks about 01, 08, and the 2020 crisis. But what they realize is in our economy is it's going to correct. So those that lean into those corrections and you stick together and you don't fight each other, you tend to win because most people are going to fight each other. So I want to touch on a couple of things Bob said. Bob, you talked about building a business and not running a farm. One of the problems that I've worked on for almost 30 years, I started a company when I did financial planning called Strategic Agricultural Management, is how do you create enterprise value in the farm? So a typical farm is either going to sell their land, have an auction, go out of business. But that's not what happens in private companies. You sell the company, you sell the cash flow. You might keep the land and keep the buildings. So Gary Harshberger and I have been working for, 6 or 8 years on how do we develop an operating system that captures the value of the enterprise, not just the land. And that's the biggest challenge I believe farmers have today. And Bob, you pointed out, some of these people converted to a business. And so if farmers can solve that challenge, you'd be the richest people, and some of you guys are, obviously, but it's a huge amount of money you're leaving on the table by not creating enterprise value. The other thing I'd tell you is if you own solar farms, we have $1 billion right now that we can spend with a private equity group to buy your contracts, not your land. So why does that matter? Well, you can take that and buy 4 times the amount of farmland that you have under that solar panel, and you get to keep the land, and you can do it on a tax-free basis. So if you don't know about this, you should know about it. And I think the same thing with windmills.
Hey, John, hang on a second. I don't know, John may have gone through that a little quick. We talked about it, I think, last year, John wasn't here, and he was on the cusp of it. I didn't know the thing came through. If you have, because, some of the people have signed solar leases for $1,200 an acre. Where's Rob? McClellan. I think someone in Ohio just signed a 9,000-acre solar lease on a prime piece of ground in Ohio for, I think, just over, right around $1,000 an acre. But what John's saying is you can take that contract, and you've got a company that'll buy that contract out. I don't know what percent what are they paying on it, John? 70, 80, it just depends.
Xander's the expert on that. We have about 50 contracts in an AI system. If you have a contract, we can feed it in there and tell you what you want to know. I'm guessing it's like 50% of the total value of the contract. But when you look at how do I diversify my farm, do I buy more land or more businesses, I don't want to take the counterparty risk of a solar company for 30 years. So it's just an option.
It's interesting. That's interesting. I think that's a viable, if you want to cash out on like you're saying, I think that there's some opportunities there. So I think there, and John's saying also in the windmill, in wind too.
But Kevin, I think you have to come to the table quickly because I think a lot of these large pots of institutional money are going to go away. I'm just touching on a few high points. The other thing I'll tell you is the key to multi-generational wealth is changing your attitude from a high-control wealth creator to a multi-generational family leader. You have to lead your family, and it's totally different than trying to be a high-control wealth creator. And I'll give you just a quick example. When you're a high-control wealth creator, it's a finite game. It's like football. There's 4 quarters. There's a winner and a loser. The goal of that is to win the game. A multi-generational leader's entire goal is to keep your family in the game. So you have to create infinite type structures like the Constitution. It works in frameworks. It doesn't work in rules. That's why it survived. So I finally antagonized Bob enough and his wife to do an estate plan. And I would tell you, Bob's estate plan is one of the best in the world. It's the equivalent of a private trust company, but done significantly cheaper. I antagonized Gary Harshberger, and he got a plan. I don't know if Joe Newton's in here, but the key to these plans is not the legal structure. If I sell you an LLC, does that make you successful? No, it's the decisions that get made. And we do not teach enough about fiduciary decision making. I'm happen to be partnered with 2 of the top guys in the world. One of them's a Nobel candidate, on fiduciary decision making. So if you see yourself as a fiduciary, I've worked myself my whole life to create this wealth. I'm a believer of not dividing and distributing assets. When you divide and distribute, you destroy your wealth. Okay, just because one daughter is a doctor and the son's a librarian, they have nothing in common, that doesn't mean that you don't have a vision for your family that's supported by your values. We heard the last speaker talk about don't change your values, but adapt to things. Okay, I believe in patriotic capitalism. I love what our founding fathers did. I love how they're rooted in God. I also believe our capitalistic system has freed more people in the world than any other system ever. So I want my future generations to know these were my values, and I build frameworks for decision making. Okay, and in today's world, you can actually put that inside of a special purpose entity, which is a management company, and they have to go by the framework. Or there's a thing called a trust protector. If anyone in here has a trust and don't know about a trust protector can actually fire a trustee, it can add beneficiaries, it can subtract beneficiaries in irrevocable trust without going to court. Okay, it is literally the Superman of the trust world. I'm working on professionalizing that designation because it's a very, very powerful thing. But if used correctly, you can take, and I think Rupert Murdoch had a big lawsuit recently where he's trying to take out certain children from running his companies. He wasn't successful. He had to go to court. Had he had a trust protector, it would have happened for free. So anyway, I'm going to stop there. There's a lot of things that that connect all these dots here, and I'll let Kevin just, if you want to go back.
Yeah, no, I think John's dead on, and I think the whole panel is dead on. And we got to get better at investing. We got to get better at planning, long-term planning, if we want to be that visionary for our family. Like I said, and you've heard it every time at the conference, somewhere along the lines in everybody's family tree, somebody had the balls to either come here or head west. And they made a big change for their whole entire family, as far back in time as you want to go. Now, you can continue doing what your dad did and his dad did and his granddaddy did, or you are going to have to make a change. Or your kid's going to have to. It's either got to be you or your kid if you want that long-term vision for your family. And that's what I'm saying. You can't just sit and watch what my dad did or my grandpa did. I mean, I love them. I appreciate everything they did. But I got to take, and I got to, if I want my kids to have a different life, I'm going to have to be the one that goes out, studies the things, learns the things, meets the people, does the networking, and makes the changes. And, I mean, that's all there is to it. And, you know, we can start taking some questions. If Todd's got some mics, we can start toss some questions around on the investment side. Peter, what's your favorite investment next year? What do you like? What do you like in the markets?
I would never be stupid enough to make a one-year prediction. I think it's impossible to predict, but I will say what that ties all this together, and what you said is what I tell our clients all the time. Like, the way you win a Super Bowl one year, you can't run the same place, right? You got to get together, and you can't go, well, that's what did it last time, that's what I'm going to do again. We accept that with sports, but in business, we tend, especially if we are the second generation to get something, we think we can't change any of the philosophy. And everything really begins with a plan. You just have to have a financial plan that basically says, well, here's where I am, and here are my assets, and here's what I want to accomplish. And then everything will answer itself. Well, to go from here to there, I want to move the farm. I don't want to pay estate taxes. I don't want to go through the probate system. I don't want my kids to fight. Okay, I need a trust. What kind of trust? It depends how many generations you want to go, the flexibility you want to have. Are there tax consequences? That will start to answer the question of do you have to do other things? What are my short-term needs versus my long-term needs? Will answer your investment questions and what goes in private investments versus public investments. Financial plan, then you have an estate plan, and then you have an investment and tax plan that comes out of it. And what really wealthy families do, to get to the heart of your question, is there's two kinds of investing. There's tactical and strategic. And tactical is what should I buy this month or this year? And strategic is what should I do over the long run. All wealthy families, so at Creative Planning we have 80,000 families that have $1 million, $2 million, have done a good job building family wealth, and then we have several hundred families that have $100 billion and up. Those several hundred families are 100% strategic. Everything is a long-term decision. When it comes to investing, you're basically Everyone says, well, the stock market's like a casino. That's why I'm going to go buy CDs. It is like a casino if you view yourself as the house. If you go sit at a blackjack table, the odds you're going to win one hand are about 49%. If you're in the stock market for one day, the odds you're going to win are about 51%. It's a coin flip. But if you're the house in Vegas, if you go beat Vegas, the Encore Hotel doesn't say, oh God, I'm so scared if you don't ever come back. They give you free tickets to the buffet and maybe a free hotel room and encourage you to stay longer because they know the longer you play, the more likely they'll win. The longer you're in the market, the more likely you'll win. One day is 50%, 1 year is 75%. If you're in for 3 years, it's 93%. 20 years, it's 100%. So you got to start to think in those terms, not year to year, decade to decade, and that moves you from tactical thinking of what's going to happen with interest rates or COVID or wars or land prices, and it moves you to strategic thinking, which is over 5 years, what's the best decision? And that will constantly change. And then once a year, you revisit your objectives, your starting line's different, your finish line's different, and you make strategic decisions. It's much less stressful, much more profitable to make your decisions that way.
Hey, Kevin, it just occurred to me, at this panel here, you have two people that have really mastered the difference between wealth management and wealth creation. What Peter does is manage wealth. What Jeff does is create it. So Jeff's approach is exactly opposite. Jeff goes in and leverages up as much money as possible and borrows it to try to make an 8 or 10x in 5 years, okay? By the type of financial structure he uses and also the amount of leverage, okay? It's totally opposite to what Peter does. Both of these guys are masters at it. I call Jeff a venture capital private equity guy, because he's getting venture returns out of private equity. But I just want to make the difference between the difference of creating wealth and managing it, and also the fact that you actually got two of the top people in the nation here on the panel in that, which I think is fairly unique for being there and listening to these guys.
Yeah, I think Peter probably also creates a lot of wealth too. I've seen a lot of folks come out of there with with a lot of money, with a whole lot more than they started with. Let's put it that way. Jeff, go ahead. Would you have to say anything?
No, I was just
You good? You
laughing.
listening?
I was going to say the Goldman guys, before you bought them, were in our office talking to us about a fund, and I look forward to them creating some of my wealth.
And Bob, and I just show a hand. And Bob, talk a little bit about what you and I were talking about if there's interest. Bob and I would like to form a group of our peers, guys that we like to hunt and fish with, and maybe. What are we thinking, Bob? Maybe we get on a call once a month, once a quarter, talk about things, where we're at, what we're seeing, what we're putting our money in. If you guys like that, if you would want to be a part of something like that, anybody in the audience, don't you agree, Bob? Go ahead, tell them your thoughts.
What we propose is a certain investing methodology specifically for farmers and the agribusiness industry. And if I could bring up that second presentation that we prepared. It's just a few charts, but anyway, going back to our original objective of basically creating or preserving a farm legacy for our heirs who want it. Somehow we're going through the charts. Is there a way to back up here?
I think I messed you up.
Okay. There we go. Okay. As I mentioned earlier, our agribusiness industry is very undisciplined. I mean, if you think about the energy industry, there are super majors that are upstream, midstream, downstream retail, like Exxon, Shell, and Chevron. There are no such companies in the agribusiness industry. And part of the reason is that the industry is fairly inefficient. The farmers are in it for a lot of non-economic reasons, so farms are never particularly profitable returns on assets. And so we have an industry that's of not a great deal of interest to other investors. If we look at this, Kevin mentioned earlier today that he's an investor in Vanguard's S&P 500 ETF called VOO. And there's an agribusiness ETF managed by VanEck called MOO. And in the past 5 years, this chart is a look at the 5-year time frame. The S&P 500 has grown 82%, while VU has contracted by almost 6%. As a result, VU, the Vanguard S&P 500 ETF, has $1.5 trillion under management, while VU, the VanEck ETF, has just 600 million under management. So the industry, the agribusiness industry, our industry, is shunned somewhat by investors. And to me, that's a very good thing because it creates great opportunities that's not over-examined by MIT physics majors at Goldman Sachs or various other companies. And it's somewhat, you can find inequities, and Kevin and Andy and John and various others love inequities because in a market that's inefficient and there are imbalances, there's a trading opportunity. So what we look for in the investing strategy that we use was discussed in last year's panel on this, and we identify binary events, binary outcomes that would happen, and then trade around those events. And so last year we identified 5 events. The first was Trump's tariffs policy possibly leading to inflation, and Roland Famasi from Rabobank warned our audience of policy pain in the short run for food and agriculture. What did we talk about at that time about an investment? And I know Kevin likes this often, is using the CBOE's volatility index, the VIX. And at times during the year, Kevin was exactly right. By April, May, the VIX was up 300% based on the uncertainty over Trump's tariffs policies and volatility in the market. But if you'd held it over the entire year, you would have lost close to 20%. So how you trade on the VIX and how you use it as a hedge, possibly to other investing, is something that is an opportunity, particularly for those that understand the world global markets like food and agriculture. The second binary event that we talked about was continuing China-U.S. trade war. And there as an investment strategy, we discussed investments in Deere, Corteva, and Valmont Industries. Deere went up substantially for the year by about 12%. Corteva went up even further, and Valmont Industries achieved about a 35% gain on the year. We also mentioned possibly investing in some Brazilian firms last year. Minerva was one that I raised as a company I liked. It saw a 13% gain, not quite what the S&P 500 did, but there were a number of Brazilian firms that did quite well last year due to this strain between U.S. and China trade war. The third binary event that we talked about was an invasion, possible invasion of Taiwan. And we looked at a number of different possible investments that would be impacted by an invasion of Taiwan. None of us really believed that there was a 50-50 chance of an invasion of Taiwan, but it's certainly one that was possible. One of the panelists who ended up canceling just before the event was Austin Moeller from Canaccord, and he recommended a number of satellite defense companies, and they did quite well as a trade around the risk around the Chinese invasion of Taiwan. And then the fourth that we looked at was peace in the Middle East. I mentioned some Israeli companies. One in particular that I liked was G. Willy Food International, which markets a lot of Middle Eastern product into Europe. And as soon as peace started to take over in the Middle East, it did quite well and was up about 75% on the market. And then the last piece in Ukraine, we talked about various trading strategies there, and in particular mentioned some German industrials that would do well that had lost access to Russian natural gas as a result of the war, and how peace in Ukraine might introduce Russian gas, which is the world's cheapest gas reserves, back into Europe and would greatly improve German industry. So that's the type of trading mechanism that our industry can use. We understand agribusiness better than anybody. We can identify the big events that might occur in the marketplace and devise strategies around trading or investing around those binary outcomes. When we looked at our overall return versus the markets, we were able to achieve a 28.2% return on our investments, while U.S. cropland just gained 4.7% and the S&P gained 16.4%. So we were able to substantially outperform the S&P and cropland, and this type of strategy then, had you not bought farmland but held your money and invested in something like this, there's a good chance you would be able to buy more farmland at the end of the year than you would have been able to buy at the beginning of the year. And that will be what enables you to grow your operations for future generations to preserve that farm legacy. Let's look at what the real binary outcomes that we see coming this year, and we can talk about how trading strategies would evolve around those. The first two are ones, well, I organized these on the y-axis with, my son taught me this, they do this in private equity quite often. They will look at what's already been priced into the market versus a complete surprise to the market on the y-axis. And on the x-axis, they look as how this will impact the, in this case, agribusiness marketplace overall. And in looking at the binary events, two come forward from last year, and that's a possibility of a Pacific War, which would be very bullish agriculture and a complete surprise to the current market. Ukraine peace, on the other hand, is already being priced into the market. We've seen the Warsaw Stock Exchange and ETFs around that already up about 50% this year. A lot of the German industrials are up this year, and Kernel, which is the big sunflower crusher in Ukraine, is also up about 50–70% this year with the promise of peace in the Ukraine. Peace does not work well for agribusiness prices. War does. In times of war and turmoil, ag prices go way up. In times of peace, ag prices tend to slide down. So that's the reason I've got these. Something that we did not talk about at all last year, but is a very surprise, I think, and also bearish for agriculture, is peak world population. No one was talking about peak world population until about a year ago, and people have started to postulate that rather than going to 10.5 billion people on the planet by 2080, we may be seeing the peak currently. Population growth has fallen off tremendously in area all around the world, particularly Asia, but also we're seeing much slower population growth in sub-Saharan Africa, which has fallen to about 5 children per woman, and the Middle East, which has fallen to about 3 children per woman. They were substantially higher just a few years ago. The points these studies have made is that as populations lose the institutional memory of raising children, it becomes harder to grow the world population and introduce children into maybe children that didn't grow up with siblings. And so peak world population is something that we very definitely want to watch and understand how to trade around it. Another binary event that we want to pay attention to related to that is GLP-1's effect on food demand. We talked about some of this last year. I don't think anyone envisioned the impact that GLP-1s have had on alcohol consumption. Our country has seen the number of alcohol drinkers when I was in college go from 72% of the population saying they were regularly drinking alcohol to today only 54% of the population says they drink alcohol. That's been a big hit to the alcohol makers, and it's also affecting other food categories, one thing that is completely leveled off and plateaued is pizza demand. Pizza has fallen from a favored food category to number 6 in the restaurant. And part of this might be attributable to GLP-1s and the desire by recipients of those to eat more quality food.
I might just point out that Trump's recent passing of legalizing cannabis might change the pizza trend.
Yeah, it may, but it won't cancel the alcohol trend. Yeah. The next binary event that I think is priced into the market is U.S. inflation, a hot U.S. economy, Fed Reserve being much more controlled by the executive branch, and quantitative easing. Just in December, we saw the Fed begin purchasing treasuries again. That's flipped now from a quantitative tightening posture to a quantitative easing, which puts more money into the money supply, which drives asset prices, among them farmland. So I don't think anybody's surprised. I know Kevin has mentioned that Trump may want to see the Fed funds rate go as low as 1% because he likes a hot economy. If we see a 1% Fed funds rate, it will definitely be inflationary. I think that the panel would agree on that. Another binary event that we're watching carefully and interested in, I know some of the speakers have mentioned today, is artificial intelligence disillusionment and possible government backlash against the job losses from artificial intelligence. All technologies, as they're adopted, go through periods of euphoria followed by periods of disillusionment. I'm in the camp that I believe there will be some AI disillusionment, but that the overall path forward will be positive. But we'll definitely see some oscillations in that, and how that affects agribusiness as well as other investment opportunities is something we'll watch carefully. Another is extreme debt, and we've been talking about that quite a bit. A lot of what's been driving farmland prices is the desire for the dollar debasement trade and the thought that the U.S. dollar might plunge in value. Well, something that would hold up in that environment would be businesses with export income, and certainly farmland falls into that category. And related to that is China GDP versus USA. We heard earlier today, don't trust the Chinese numbers. We also heard a very positive forecast for U.S. GDP. But recently, the U.S. came out with 2.5% GDP growth for 2025, and China almost immediately came out and said their number was 5%. So we have not talked about China GDP exceeding the U.S. since pre-COVID. But, as China tries to grow its economy, if the U.S. sputters, that may be something that also contributes to Brazil, Russia, India, China's success, and possibly more of the move away from the U.S. dollar as the world's reserve currency. So that's something that we're interested in, also how this will affect markets. And then lastly, something that I often hear the founder of GMO, his name, Pete. You raised Peter Lynch earlier today. Who's the perma bear that founded GMO? His name will come to you. Anyway, he often brings up climate change as the big sleeper in the marketplace. And as farmers, we all understand climate change. How will that manifest and how will that impact markets? I'm not really sure, but it's something that we definitely want to follow and look as a trading opportunity to improve our returns relative to the overall market. And then lastly, an unknown is environmental regulations and, of course, around renewables and biodiesel, which was talked about on the last panel. So those are the binary events that we're trying to identify. Last year, trading around those binary events produced, like I say, a 28% return, which beat the S&P. We will continue to look for those, and then what are agribusiness trading strategies that we can see that would lead to income. There are a number of vehicles that can be used that Kevin was talking about in investing. Some of the simplest avoid FINRA regulation as long as you limit the number of investors into a partnership to 100 or fewer, and qualified investors. Not advertise. We would be careful not to advertise, but I think it would do the industry a lot of good and bring a lot of discipline to the industry if we could have the top minds in agriculture look at investing in opportunities that improve agriculture. And imagine the prestige if you're a young company or a mid-tier company that had the endorsement of the top 100 in agribusiness as one of your investors. So I think there would be opportunities, like Kevin says. None of us are trying to make any type of big commissions or anything, but actually improve the industry's discipline and overall money-making opportunities for the farmers that are trying to preserve this legacy for their heirs who want it. So that's it.
I agree. I concur. I think Bob and I are looking to form a group. I also think Jordan's looking to form a group maybe of younger kids that want to learn about investing and, maybe don't have a ton of money to throw around, but just getting started, and form a group where he can gather with some of those folks too. So if you guys have interest in that, we'll circulate some things after the conference to everyone who attended. If you're interested, maybe we'll be on some calls coming up, and we can form these groups and those things. Bob will be around the rest of the conference. He'll be on another panel maybe at the very end for some Q&A. Peter's got some guys and some folks that have a booth downstairs if you're interested, need any help from them. And John's always around. Jeff, like I said, we'll introduce everyone to Jeff in the group. So we're going to take a break.
Hey, Jeff, one thing real quick. Great presentation. Gary Harshberger introduced me to a guy who's built a nuclear recycling company. And so it's really taken off. Next year, if you want to, Kevin, we'll get the experts on nuclear. You're hearing a lot about nuclear small modular reactors. We have access to the top people. So, Kevin, if you want to do that next year, because it's a hot topic.
Yeah. Everywhere I go, Gary, there's tons of people talking about, small nuclear reactors and different things on that energy front. And I know Carter will bring it up tomorrow on some of his talks. And so, like I said, there's tons and tons of opportunity. And, I think you just got to be selective. You got to have a plan. You got to have a long-term vision. And like John said, maybe you put a little constitution in place for your family and, try to build it out that way. So I appreciate everyone that is up here that took their time to come in and help. If you got any questions later, be sure to hit them up. Come back at 3 for the keynote speaker at the end of the day, and you'll really want to hear it. It's going to be a good one, so appreciate it. Thanks.
Thank you.